Well, it's the start of the second quarter, and we're just a few weeks away from a new earnings season. And of course, in the backdrop is the Federal Reserve's looming policy shift and a dollar that continues to strengthen. So after months of volatility across the markets, what should your playbook be going forward? Liz Ann Sonders is the Chief Investment Strategist at Charles Schwab and joins me now on set. And Liz Ann, it's good to have you here. Welcome.
Thanks. Nice to be here.
So how are you feeling going into second quarter and, of course, the start of the first quarter earnings season, which begins in a few weeks? Forecasts are looking pretty bleak for earnings. Does that worry you?
I think in the short term, so we're looking at earnings that have actually gotten a little bit better in terms of expectations. About 2 weeks ago, expectations were for a drop of as much as 6%. Now, consensus has moved up to about -4. So we're still in negative territory, probably stay in negative territory into the next quarter as well. Now, normally earnings don't go negative other than when you're in a recession. But there have been a couple of notable examples of periods where we went negative, but it wasn't an example of recession, 86 and 1998. Both were environments with strong dollar, weak oil prices. And I think when we close the book on this chapter of negative earnings, it'll be the same thing. It will not be recessionary type conditions, but indicative of the issues associated with those two things.
All right, now an easy question to ask, not necessarily the easiest question to answer, but where do we go from here? Is there a point that you're watching that would be a good entry point?
I think investors should be very careful about concepts like entry points, get in, get out. That's gambling on a moment in time when investing really should be a process over time. And I think that's one of the biggest mistakes investors make is the feeling that the get in, get out is some, day or level on the S&P 500. We came into this year with a view that it was likely to be a tougher year, a more volatile year, less movement ultimately by the market, but with some volatility around it. And we certainly saw that in the first quarter. In fact, until 2 days ago, we went 28 days without the market being up 2 days in a row. So a lot of violent action to really get you nowhere. And I think that type of pattern is probably going to persist in the second quarter.
All right, well, going forward, what sectors should investors be watching? I mean, should they be looking more at small cap stocks with less global exposure given the strong rally in the dollar?
You do tend to get the domestically oriented companies housed a bit more on the small cap. We're actually neutral from a cap perspective, but if you have the ability to screen for or look for companies and industries that tend to be more domestically oriented, those have been outperformers and they will likely to continue to be outperformers. In terms of our sector recommendations, technology and consumer staples are the two sectors on which we have outperform ratings, which effectively is a bit of a barbell with tech certainly more on the cyclical side and consumer staples a bit more on the defensive side. So kind of playing both sides of that in a more volatile period.
All right, now is it hard to be bullish given all the noise in the background that we're dealing with? We have the Fed uncertainty, the dollar, lower earnings forecasts, low oil prices. How do you play with all that?
So I am more cautious this year, as I mentioned, and we have effectively a market weight or a neutral view on the market. However, it's in the context of a secular bull market, which is what I think started 6 years ago, that still has time to go. So short-term period where the market may have to, or earnings have to catch back up to valuations. But I think what we're experiencing now is an environment which has been difficult for investors to be optimistic. Through this entire 6-year period of time, a tremendous amount of skepticism, worry still. That to me is a signal that the wall of worry is still very much intact and that we're nowhere near the kind of euphoria that tends to mark major bull market peaks. I just think within this secular bull, we're in a period of consolidation right now.
And it's 17 times earnings. I mean, that's pretty much in line with where things have stood historically.
Yeah, it's a little bit above the long-term median, which in and of itself doesn't suggest a major top concern. But again, given that we're in a short-term period of earnings growth dipping into negative territory, which in turn has pushed up the PE, you may need to get out of this earnings weakness period and have earnings catch back up to valuation.
All right, let's talk about the Fed real quick. When do you think they're going to raise rates, and are investors just too obsessed with the central bank?
They are a little bit obsessed with the central bank, but when you've gone over 6 years at 0% interest rate policy, I think it's natural to worry about the beginning of the exit. We don't forecast timing, and I think the Fed truly is data dependent. They don't know what they're going to do, and they're just a lot of people, I think that they already have some preconceived plan and they're just deciding when to inform the market. So they'll watch the data. We think it's more likely probably September as opposed to June, but if the data picks up between here and then it could be we could move to June. But we think it's later this year, and at most you get 2 hikes in 2015.
All right, Liz Ann Sonders, Chief Investment Strategist at Charles Schwab. Thanks for coming in.
Thanks.
I'm Scott Gamm, and you're watching The Street.